Okay, let's go deeper into the NPV method and understand how to do a NPV question or problem. Fine. So before going into NPV method, we will go and we will see some basics. Okay, what are required here. So see, you already know that when you start the project initially, I have already given you an idea about NPV method, correct? So let me explain you a question here regarding NPV method and how we prepare NPV method. Okay, but before going into that, okay, this is the question. You need to read that. See, there's a format here. Fine. There's a format here. So by seeing this format, you can easily understand the investment has been done here. The investment has been done here. Initial investment. So this particular NPV question is regarding investment done on equipment. That is, company is planning to buy a equipment, and the equipment will be bought definitely for what purpose? For production purpose. And if company is considering to buy a new equipment, then either they are starting a project or they are planning to replace the old with new. So we have not been given all those information. Let us understand. Here it is. Here what this question says is the investment is on equipment, and that equipment would be used for production purposes, and when production would be done, that production like after getting the finished goods, those finished goods would be sold and we would be generating cash inflows. So that is the idea behind all this. Okay, so yesterday I have given you a rough idea about NPV method. My question was very small and minimal question. This is a question with all the things what should be considered for doing a NPV problem. So initial investment at the inception, that is on like year 0, that is Jan 1st, you can take. Then I have already yesterday given information to you regarding working capital. What I said is, to run a business activity, two types of finances are required. One is short-term finance, or if you want to start a project, you would be having daily routine activities. You need to make wage payments to labor, you need to buy some inventory on daily basis. So all this stuff would be there. For that you require working capital. So here again, working capital is also invested, and there is a star mark here. If you want, you can make a note of this. See, working capital is always expected to be recovered at the end of the project's life. If you want, you can make a note of this. Working capital is always expected to be recovered at the end of the project's life. Here the project is ending by year 9. So we expect this working capital, which is a negative figure here, since it is an outflow, to be recovered here. Okay, so we are expecting that to be recovered here. So if you have made a note of that, I am moving forward. So now you can see here the next column is, I already told you yesterday, whenever you are doing a NPV question, if I have not said yesterday, today I am saying that point. If I've said, I am repeating it. Tax consideration should be made. That means you cannot expect any cash flow in the future without the reduction of taxes. That means any business activity you do, you are liable to pay taxes to the government. Okay, tax to the government. So here our cash flow before tax was 50,000. I'll show you the question. They have done a lengthy working. I don't believe in that lengthy working and all. It's a simple question, can be understood in a simple manner. Okay, the data is not given. They have just given a question with a tabular form question. That's it. Let me search the question. They didn't give it. Okay, we will understand. No problem. So with this project of investing in equipment, you would definitely invest and then you start production and then you would be receiving cash inflows. The cash inflows you would be expecting at the end of the year. That means Jan 1st you started the project, December 31st you are expecting 50,000 you would receive. And that 50,000 you have to deduct tax from that. That means 30% happens to be the tax rate. So either 50,000 into 0.70 you can do, you can take 70%, or 50,000 into 1 minus tax rate. You can do this. That is 50,000 into 1 minus 0.30. So if you calculate this, you would be getting 35,000. You can do in your calculator once. All right. So if you have done, you would have found it to be 35,000, and that you would be receiving at the end of every year. Then comes the next point, depreciation tax shield. Now, what is this depreciation tax shield? See, when you invest your money in capital projects, that means the projects which require huge capital and the projects whereby you are buying some equipment, plant and machinery, building, etc. You know, there would be a capital cost. That is nothing but the depreciation, if I'm not wrong. Yes, please tell me yes or no.
Yes, sir.
So depreciation would definitely be there, because all these assets what I have written on the screen are depreciable assets. That means they would depreciate because they have an expiry date. They cannot, it is not like land which doesn't have an expiry date, because you know land doesn't have a life. It is always there. We human species would be there or not, but land would be here itself. It was there, it is, it would be there. Okay. But all these things are man-made, so they have an expiry date and they would get depreciated. So what the governments do is, usually for these expenses they give you deduction facility. That means they give you some kind of relief, tax relief. Okay, when you file your tax returns, these depreciation kind of expenditure is tax deductible. That means this would help you to reduce your future tax liability. Now please tell me, did you understand in simple words what I am saying? Hello?
Yes. Yes, sir.
Yeah, Zarina?
Yes, sir.
Yeah. So how it would reduce your tax liabilities? This is my accounting, this is my accounting records or financial report, what you want, you can say. This is my tax return. Here my profits happen to be 1 lakh. Here my profits happen to be 1 lakh. Okay. And this depreciation, what I have, I can, like, this is an expenditure. Okay. This I can deduct here as 20,000. Okay. Because I can claim deduction. And I would be paying taxes based upon tax returns, not based upon my financial reports. This is what you should know beforehand. So my tax here, I would this is my this is my profits after depreciation. Please understand, this is my profits after depreciation. This is my profits in tax return before depreciation. Now I am deducting depreciation, so I would get 80,000. So this 80,000 is a lesser amount, okay, than what we are seeing here in the financial reports. Financial reports we prepare to see what our profit is going to be, and we definitely make provisions to pay taxes to the government. We make provision beforehand, but we have to pay the tax based upon our tax returns. So here 80,000 is what is my profit, and on that if I pay 30% taxes, it is 24,000. Okay, and this 30%, and since this depreciation has reduced my figure of 1 lakh to 80,000, I was supposed to pay 30,000 as my taxes, but now I am paying 24,000 as my taxes. 6,000 of the tax money I have saved. This happens to be my cash savings. Both of you understood what I'm saying? Hello?
Yes, sir.
Yes, Zarina, is it
Yes,
clear?
sir.
Should I move forward?
Yes, sir.
Yeah. So this 30% I am deducting. Sorry, this 20,000 was my depreciation, which reduced my profit, because I can claim this as deduction and reduce my tax liability. Now I have to pay tax on 80,000 rather than paying on 1 lakh. So I am paying 24,000 as my taxes. Otherwise I would have paid 30,000. It has given me a cash saving of 6,000. This also is a cash inflow for your project. So we give that as a name, we give that a name of depreciation tax shield. So depreciation tax shield is nothing but this is a tax shield. Why? Because it is supporting you or helping you from additional taxes. It is shielding you from paying additional taxes. It is saving your cash. It is giving you cash savings and stopping you or preventing you from paying additional taxes. And this, it is not happening because you have done some good deeds. It is what government gives you. It is what government gives you the benefit. Okay, it gives to everyone, every company. Hopefully both of you are having a subject called taxation, and you would have, you definitely know this what I'm speaking. Okay, let me move forward. But here now, what you have known till date is straight line method of depreciation, diminishing balance method of depreciation. But in our case, see, these are the two methods as per the US GAAP, see, IFRS. As per IFRS, you can calculate your asset depreciation based upon these two methods. These are applicable methods. As per US GAAP, since US GAAP is the standard which you are learning, it is a United States based standard, accounting standard. Straight line method is all right. There is a double declining method. Okay, so these two methods are applicable when you prepare a financial report. But as per the IRS, like that is like Internal Revenue Services, that is US tax department, you can say that US tax department, they say that you can use double declining, straight line, we don't mind, but we would recommend you to go with MA modified accelerated just a second, because something. MACRS, modified accelerated, just a minute, cost recovery system. Okay, so they say you go with this kind, with this method. It is better if you follow this method as per the US tax laws. But they are not adamant that you should definitely follow this always. You can go with other methods, but here what they are recommending is, we will read out this point. MACRS or modified accelerated cost recovery system is the most common type of depreciation required by the US tax laws. Although it is not the only accepted method a company can use on its tax return, remember that the depreciable base for tax purposes, that is your asset, if you want to depreciate that asset which you want to depreciate is called as depreciable base for tax purpose. That is called tax base of an asset. These are all new terminologies. Don't panic with this. Tax base of asset is nothing but if you are filing income tax returns, and if you are showing your asset in the income tax returns balance sheet, what you are preparing, then this would be called as tax base of an asset. Okay, that suppose you are showing plant and machinery as 1 lakh in your tax returns. So if someone asks you what is the tax base of your asset, it is nothing but 1 lakh is my tax base of asset, which I am showing in my tax returns. So they are recommending you to go with MACRS method, and let us see this MACRS method, what it is all about. Here some convention you should follow, half year convention. What is this half year convention? See, There is some XYZ asset, suppose plant and machinery, and that has to be depreciated based upon MACRS method, modified accelerated cost recovery system. Okay, so given the depreciation would be for 3 years, that means the asset would be having a lifetime of 3 years. The asset would be having a lifetime of 3 years, but the depreciation what you would do or calculate would be based upon this convention. First year you should calculate only half year's depreciation. Second year you should calculate the complete year's depreciation. Third year you should calculate the complete year's depreciation, and the fourth year you should calculate half year's depreciation. Altogether it has a lifetime of 3 years, but we divided that 3 years into 4 years. How did we divide that 3 into 4? Because we took the first year half and the last year half. Okay. Please have a look through this. I'll move forward and give you and solve an example to prove this. Any doubts? As far as I'm concerned, I don't think you're having any doubts. If you have, you can just bring it to my notice.
No, sir.
Okay. Zarina, is it all right for you?
Yes, sir, it's all right.
Yeah, new concepts, but okay, but they're not that complicated ones. So here they have given the percentages, just you have to apply the percentage. So first year, half year convention. So first year you would be applying 33.3%, second year, third year, fourth year. And don't worry, this percentages would be given to you. No need to mug up, no need to by heart. Okay. This was for 3 years. If it is for 5 years, then first year half, last year half. 5 would convert into 6. That's it. So now you can see the amount of depreciation to be taken for each year for an asset with an original cost of 90,000. So we are depreciating this 90,000 worth of asset. We would depreciate it 100% till its lifetime, but we would depreciate it in this manner. First year, that is, it is half year in the first year, 33.33%. Second year, we will apply this percentage. Third year, this percentage. Fourth year, again half this percentage. So this is the 90,000 asset is getting depreciated in this manner, and by its lifetime it has got depreciated by 100%, but in this way. Okay, please have a look to this. We'll go forward. Okay, let's move forward. Now this depreciation amounts what you are seeing, you can use this for your tax shield. How? We will see here. So they have given you one more example for MACRS method, and you can read this question. CMA Products Inc. is considering the purchase of a new piece of equipment. So the question what we were seeing, the same question they have given here. To introduce a new product line, the equipment will cost $125,000, including some setup cost, installation, everything in this. So that is all together this amount, all inclusive. The estimated before tax annual cash flow. So you are expecting these cash flows for some, hopefully 9 years, the coming 9 years. Investment will require an initial investment in working capital. So that also we have seen, and they say you have to use MACRS method for depreciation calculation, and the tax rate happens to be 30%. Okay. And they are even giving one more information that this asset would have a salvage value of 10,000. That means at its life and at the end of its lifetime, that is in the year 9, if you sell that asset which was of 125,000, would fetch you $10,000. So this information, please read this. I'll just give you a fraction of time. Okay. So that's what we have here. Let's move forward. And they have given the information here. Okay. The equipment will have an economic life of 9 years, but will be depreciated for tax purposes over 7 years using MSERS method. So this is the information they have given. Okay. MSERS depreciation rates for each of the 8 years using half year convention. So what has happened? They are saying that equipment will have an economic life of 9 years. That means till 9 years it will give you cash inflows. That is what they mean with economic life. But it will be depreciated for tax purposes over 7 years. That means you may get some value at the year end even. See, at the end of the life of that asset, it is giving you $10,000. That 10,000 is what here it is written. But you know, they have written 7,000. Why? Because they have deducted taxes. So when you will be selling the asset at the end of its lifetime, which is 9 years, then you would be getting 10,000 into 30% tax you should remove. So I'm taking 0.70 directly, 7,000. But the depreciation is applicable only till 8th year. Okay, that is the information given to you in the question. Here it becomes a scrap. So almost all it has a zero value. Okay. So we can see from here the asset would be depreciating from the year end, that is first year's end. So 1, 2, 3, 4, 5, 6, 7, 8. So here we have 8 years. But what they have given the information to you? They have given the information that the equipment will have an economic life of 9 years but will be depreciated for tax purposes over 7 years. So 7 years spread out in how many years? 8 years. Why? Because we are using what method? Come on, please tell me. Hello? Tell me. You're not answering. What is the method we are using here? Come on, this won't do if you don't answer. Modified accelerated cost recovery system, and here the depreciation should happen for 7 years spread out in 8 years because of the half year convention. First year half and last year half. Is it so? Isn't it so?
Yes, sir. Yes.
So please answer, please answer. So first year half, one, then full, and then half. Okay. So that, so 3 years were spread into 4 years that time. You saw that. So we would take this depreciation rates, okay, and we would apply this depreciation rates to what? To the asset or equipment value. Okay. So this is what is my equipment value. This is my depreciation rate. This is my equipment value or asset value, and this is my tax rate. Altogether, I am getting the amount of depreciation tax shield. That means I have saved my taxes to the tune of $5,359. This is a pure cash saving to me. Okay, and I would give this as what name? Depreciation tax shield. Okay, so please calculate this one. Okay, I'm giving you time, and I have told you need not remember these rates that would be given to you in the question. No one can remember that. Even no need to remember. It's irrelevant. Yeah. So I think you're calculating.
Yes, sir.
Yeah, yeah, yeah.
Yes.
Okay. Yeah, please carry on. Let me know when you're done. Okay, so done. Shall we move forward? Hello. I'm waiting.
1 minute, sir.
Okay, okay, okay. Take your time. I'm waiting. No problem. Okay, I hope you have done. So let me move forward. So this also I've explained you at the end of the equipment's life, you will be selling the equipment for 10,000 as it becomes a scrap, and you'll be deducting tax. So after tax amount on the disposal of equipment is this. Okay, that means after tax cash flow from disposal of the equipment is 7,000. Okay. So since we have done almost everything now, let us put everything in the format. This is the format. I've discussed this, and I've discussed the cash inflows, after tax cash inflows. I have explained you how to find out depreciation tax shield, and you have found out the amounts here. All these amounts you should take, post it here. This is the after tax disposal, after tax cash on disposal of the equipment. Then next step is nothing but to add up all this. Okay, so 125 and 25 becomes 150. 35 plus this becomes the amount, and you can add this all. I'm just putting addition sign here. Okay, and then you have the cash inflows here in totality. Please do this calculation. Then last step I would explain you in the coming page. Done with NPV problem. Okay, so do this. I'm waiting. I'm giving you 2 minutes time. Okay, so if you are done with this, now let's apply the final thing to this, the discount factor. So they have given some information regarding that even. They say the minimum required return or the hurdle rate. So they will give you such kind of information. The hurdle rate is nothing but the minimum rate of return on a project or investment required by company management or an investor. Why this happens to be the minimum required rate of return? After adjusting, see, minimum return is nothing but at least your cost should get recovered. Okay, at least your cost should get recovered. That should be the minimum required rate of return. If I invest in a project, I cannot be very much bullish on that I would get so and so return, I should get my desired return. No, I cannot be that bullish, na, because it is an estimation. So I would estimate minimum return I should get, so that return should absorb all the cost of the project. Am I right? Please tell me yes in chorus.
Yes, sir.
Yes. So minimum cost I should be able to recover. That should be my estimation. I cannot be that bullish. Okay. Now, so usually every NPV problem, there would be some return the company management would expect that they should earn that, and that is given in our question even. So we will take here the required rate of return what these guys have. Just a second. These guys have asked you to consider is 10%, it seems. Okay, so we will take that 10%. I'm into NPV method. Tomorrow I'll wind up payback and discounted payback and ARR, all the kinds of methods, whatever you have, I'll wind up all of them. Then we'll discuss some theory in details. So, okay. So here we have 10% is the minimum return what company wants to earn or investors want to earn. Company is the investor here. So you can take that discount factor. How you can find it is 1 by 1.10 whole power 1, 1 by 1.10 whole power 2, 1 by 1.10 whole power 3. If you are not interested in doing all this, this kind of calculations, there is a table given for your remedy. You can go to the last page and check the present value tables. Hopefully they may have given the tables here. Yeah. So they may use some terminologies like annuity and all. So I will explain you that tomorrow. So today you only focus here, this table. Present value of $1 at the rate of 10%. So for how many years? I think for 9 years. So you can take this whole 9 years from here. Okay. And if I'm not wrong, they have given the same thing there. Or you can calculate in your calculator also. You can easily calculate these values. You can follow this trick. 1 by 1.10 year 1, then again is equal to for year 2, okay, 0.826, again is equal to year 3, again is equal to year 4, again is equal to year 5, again is equal to year 6, just 3 values after decimal, year 7, year 8. So all this, and then year 9. So whatever you can consider and you can calculate. Okay. So you can also do the calculation here. Whole power 4, 1 by 1.10, whole power 5, 1 by 1.10, whole power 6, 1 by 1.10, whole power 7, whole power 8, 1 by 1.10, whole power 9. So you can find out all these discount factors. You can multiply these discount factors with the cash inflows, what you are seeing here. Just do the multiplication. You would get the present value of these future values. These future cash flows, present values are here. You can do addition to all of these, add them, and tell me what is the total. This is nothing but present value of cash inflows. Okay, these guys are, what they are doing is they are kind of following a different method of cumulative cash flows. No need, you can just add up all this, see what you're getting. I think we would get 2,42,145. So from 2,42,145, that is PV of inflows, summation of this minus the present value of outflows. So 2,42,145 minus 1,50,000, you would get your NPV as 92,145. This is your positive NPV. You can accept the project. just go through that. Okay, finished? Hello?
Yes, sir.
Yeah, Zarina, you're doing? And Smriti, done?
Yes, sir.
Yes, sir. Done.
Okay. So please review the question for today. And there are some theory I need to discuss tomorrow, very crucial theory. So we will discuss some more things to be considered while doing a the investment decision. Some more factors to consider before investing our money into a project. So this particular box we are going to discuss, and we are going to do payback and discounted payback period method tomorrow. Okay. Bye bye. See you tomorrow. Yeah.
Thank you, sir.
Thank you.